it's interesting, the topic, revisiting the 60-40 mindset in the multi-asset world. We had a panelist prep call just about 2 weeks ago, and one of the panelists said, why are we still talking about this? And before I could answer the question, Sally answered it herself, which is we've got all endowment and foundation money represented up here. And if you look for the very first time in the 10-year fiscal year ending June of 18, the 60-40 model beat every one of the Ivy Leagues, 0 for 8. So the 60-40 is up 8.1%, and the rest of them are below that level. Different stories for 15 and 20 years, and whether or not this 10 years is unusual, we're going to certainly probe that. But this concept of hashtag Tina that has come into the social media vernacular, there is no alternative, that's literally been true from the investing world over these last 10 years. And to make matters worse, two avuncular octogenarians in Omaha, Nebraska, just last week at the shareholder meeting at Berkshire Hathaway, proceeded to throw alternatives under the bus. And this year they were not picking on hedge funds, it seemed to be the private market. So a lot to cover in a short window, but I thought it would be helpful to have each one of the panelists introduce themselves, not so much themselves, the bios are in the program, but a thumbnail sketch of their plan. So Steve, I'll start with you.
Great. I'm Steve Algert with the J. Paul Getty Trust in Los Angeles. We're a $7 billion operating foundation. We operate the museums. So we're a little different in that we have no new money coming in, but we have 4 to 5% going out every year in expenditure. So it'll be a little different from a pension or an endowment. And I'm also a CAIA charter holder.
Outstanding infomercial. Thank you. Sally?
I'm Sally Staley, currently the investment committee chair and a trustee at the College of Worcester in Worcester, Ohio, my alma mater for undergrad, and formerly a chief investment officer of a $2 billion endowment at Case Western Reserve University.
I'm Angelique Sellers with Penn State University Endowment. We manage just north of $4 billion. And so our university does have inflows, so it's easier to manage liquidity. And also we don't support a whole lot of the operating budget of the university, so we just bring this up just to sort of differentiate between the panelists.
Sure. I'm Jim Bethea of the University of Iowa Center for Advancement through the fundraising arm for the University of Iowa. I'm the chief investment officer. We're $1.1 billion, and our spending is offset by our flows from new gifts every year, so it's about 4.5 out, 4.5% in. We represent 2% of the operating budget of the university, but the endowment also represents 33% of the operating budget of the University of Iowa Center for Advancement.
You left out the part about CAIA member?
I'm a CAIA member as well, and a Case graduate.
Thank you. So, Sally, I'm going to start with you because you brought this up on the call, and I thought it was a very interesting observation to begin the discussion. Why are we talking about the 60-40? This is my parents' asset allocation model, and yet it's sustained these last 10 years. Should the conversation be on that topic?
The 60-40 benchmark is the mother of all benchmarks. It's the starting place for every portfolio and the place where we look at its return and look at how we can add alpha through diversification, through global investing, through different asset classes. So it's our starting point, and it's something that even a multi-asset global portfolio should still consider one of its main benchmarks. It's not the only one, but it's one of the jobs we have to accomplish over time, beat the 60-40. If not, we should go home.
Jim, fair fight over the last 10 years? It seems like this monetary intervention has sort of been a backstop that used to be to prevent drawdown risk. You needed to have diversification, a long-term game plan, but now it seems like the central banks have provided a little bit of a floor, and this has persisted. 10 years used to be several market cycles, so has it been a fair fight over the last decade?
I think it's been a fair fight in the sense that if you said all you want to do is have the highest returns, then maybe you should go. I would say you should have been 100% equity. Why would you have any fixed income? But that's not really what an endowment is trying to do. You know, our risk isn't that we outperform our 7 to 8% target. It's that we underperform it and we invade the corpus and maybe you suspend spending. And nobody 10 years ago was saying that our returns are going to be 10, 11%. So I think you could argue, if you know, looking back, that it hasn't been a fair fight, but nobody was saying that we should change our asset allocation. And if you think back 10 years ago, the endowment model did better than 60-40. People forget that. Hedge funds lost so much money. Well, the equity markets were down 50%. And if we're down 50%, we're laying off staff. And that's not something that we can do.
Sally, did you have
We're
a
picking and
follow-up?
choosing our 10-year periods
Yeah.
and trying to fold the conversation around that. We have to succeed in every 10-year period, no matter what the markets deliver, the market opportunity, no matter what the global setting. So to pick one 10-year time frame that makes what you're doing look either really good or really bad is not the right approach.
Yeah, I agree, and we were talking just as we were getting mic'd up about some of the participants have talked to some of you talking about 3-month track records, year to date. So I think the mindset of being a long-term investor gets muddied, but it used to be 10 years represented several market cycles. So Angelique, if I look at that and picking up on Sally's point, the worst year in this 10-year period for the private markets was 09. So that is rolling off. So just standing in place, I assume these next 10 years will prevail above the 60-40. But the 15 and 20-year numbers have been ahead. So is this an opportunity to change the mindset and go more traditional, or keep on keeping on with an asset allocation view?
Oh, we are keeping our asset allocation view. Now, precisely, we do have somewhat of a push, I know, in the industry towards more passive, less expensive investments, given the recent performance of the markets. But I'm of the view that it's precisely the wrong time to change that allocation. Return expectations may be lower going forward, and this is why we try to build diversified portfolios. We try to add alpha through private equity, through venture, through some global investments. And just looking sort of in the niche areas, trying to see some more uncorrelated, to find some more uncorrelated return streams, like in the royalty space and other areas like that.
So I'm going to come back to that later because you're in good company. Harvard Management was in the news this week about their allocations into hedge funds, but I'm going to come back to that in a moment. Steve, you're a bit unusual relative to the other 3 panelists in that I don't think the Gettys are giving you any more money. So preservation for capital is absolutely critical. And when I think about it through that lens, and this may be true for the entire panel, the ultimate benchmark might be the spend plus inflation. So if the normal drawdown is 4 to 5%, and over the last 10 years, I think inflation was 3-ish. So you really need, I think 8% might be the true bogey, but how do you look at benchmarking your returns? And is it against a drawdown plus inflation, or do you look at it some other way?
Again, we don't know what the future is going to hold for us. And again, I think probably the reason we always looked at the 60-40 for so long and kept that as a benchmark is we thought it'd be easy to beat. So let's put that out there as a benchmark because it was going to be easy to beat. Now, if you look, we've had a bull market for equities and fixed income, but in this current environment, what can you do going forward? If we stay in a low rate environment, what's your yield going to be? Sub 3%? And are you probably going to even go out long on the curve if you want to do that? If you think there's a risk of rates going higher? Equities, again, we just had our investment committee meeting yesterday. We look at 10-year numbers through March 31, 2019. So it started April of 09, the absolute bottom. For 10 years, we've done over 10% annualized. We don't expect to see that again. It's been a great time the last 10 years. But if we go back to 10 years ago when we were doing our budget after 08, we cut our spend 20% because we'd lost 20%. So we have no new money coming in. So we could have either kept our spend up and really depleted our assets, or let's cut our spend. And 10% was easy to do. We've got acquisitions and other things, but the other 10% we were cutting a little bit to the bone to get rid of people and programs. We don't want to have to go through that again. So we really have to balance off what's the risk of a drawdown we can tolerate versus how far out do we want to go on the risk spectrum to try and get a return. And maybe inflation in the art world, of which acquisitions are a big part of our budget, is even more than CPI. So we probably should be looking for 8% plus every year, and that's going to be really hard to do going forward.
And where do you expect to find it? Would it be in the less liquid markets? And every crisis is a crisis of liquidity. And if we have any bubble growing, it seems to be this risk-on trade. And being long illiquidity, whether you're being compensated for it, maybe we'll kind of come back to, but how do you look at some of these less liquid strategies, and are they more or less prevalent as you look out over the next, say, 3 years?
And again, I'm different than some of my colleagues. I say, okay, we've had a great 10-year run. Maybe we should just ratchet down our expectations and not take risk for the next few years, not take as much risk. Say, okay, we're going to do less than 8%, but over a longer cycle, we're averaging out to 8%, and over the next 2-3 years, maybe we'll have a correction and things will look attractive then. But is this the time to be piling on and keeping risk on? I don't think it is. So again, I'm probably being a little more cautious, and I've kind of got oversight for about a quarter of our portfolio. I'm a little more cautious there because I want to wait. I know there's a better opportunity coming than what we have right now.
Well, I think when we talk about the value proposition of alts, we talk about bringing more diversification, less drawdown risk, higher returns on a risk-adjusted basis over time. And I just want to come back, Angelique, to the point I just mentioned, that Harvard is now 1/3 in hedge funds. And I don't think hedge funds are an asset class as an industry, but about 13 billion of the 39 billion has gone into hedge funds over the last couple of years. And this is one time where I think the media got this absolutely right. I saw something on Bloomberg just this morning, and they talked about the fact that they are looking to de-risk this portfolio, thinking that some of the points Steve raised a moment ago are at the fore. So how do you view hedge funds? How do they show up in your portfolio? And are they risk mitigators or return enhancers?
Yeah, so hedge funds is such a wide category that I have to differentiate. So we call our allocation to primarily hedge funds diversifying assets, which means primarily diversification away from otherwise very heavy equity risk in our portfolio. We have about 45% in public equities of various flavors, and another close to 30 in private capital. So it's a very equity heavy portfolio. And so our primary goal for our diversifying allocation is that diversification. They actually benchmark to Barclays Ag, and that allocation has done really well for us. And it's about 12% of the portfolio. It's not that large, so that probably is going up going forward. But when people ask me what kind of strategies we're using them, every manager there is its own strategy, so there's no categories there. And we typically stay away from the long-short equity strategies that the sort of plain vanilla 60-50% net long. We take that risk on the long-only side. So all the in diversifying, we have volatility arbitrage, we have fixed income arbitrage, credit arbitrage, all kinds of sort of uncorrelated, low beta type strategies.
Jim, in your plan, I assume you have a model portfolio, a target asset allocation. Are you above or below your expectations in the alt space?
It depends. So on the hedge funds, below. On private equity, massively above. So what we did was we took a look at what are we good at and what are we bad at. And we're bad at picking particularly long-short equity hedge funds. And maybe that's because long-short equity hedge funds are just bad to begin with, and we just, so you're starting with a headwind, I guess. But we're really good at picking private equity. And so we are against public market equivalents, depending on whichever public market you're using, 500 to 900 basis points above. So we don't expect hedge funds to beat the public markets by 500 to 900 basis points. And the volatility reduction you get on a long-short equity fund is great, but we don't need it. We're long-term investors, so we say we'll just go into private equity and not worry about it. And part of that is because we are long-term investors. My investment committee met last Friday. We look at 3, 5, and 10. That's it. We don't look at one-year numbers. We don't look at the quarterly return numbers. And because we have that longer-term mindset, we can actually take a little bit different risk than some other folks. If I had to worry about my one-year number, I don't know if I'd be worried about I'd be investing in the J-curve of private equity.
Well, I think if you watch CNBC, you're worried about the intra-minute number. So I think the mindset...
I don't watch CNBC or Fox or any of them. I think they're all... that's talk radio. I don't...
Let's hope they're not a sponsor for this conference. Sally, Jim brought up an interesting point about being good at picking managers in a certain strategy, and due diligence is very important. It was in the news again recently with one particular private equity manager, and both the concept of initial due diligence and then ongoing due diligence. And I think that a lot of folks, a lot of plans paid great attention either themselves or with the consultant on initial operating and investment due diligence, but maybe a different story over some period of time. How do you view this, and how do you see the evolution and the importance of it?
Due diligence is not a once and done thing. It's not initial at the moment the investment decision is to be made. It has to be ongoing. And different funds, different plans treat that in different ways because they have different resources to work on it. But it can't be once and done. The investment due diligence, the operational or business due diligence are becoming equal components of at least initial, but also ongoing. So whether you're depending on advice and direction from an outside consultant who may or may not be a fiduciary, or whether you're doing that work with internal staff or with a very active investment committee, it has to be well-rounded and consistently applied. And we have more and more access to more and more information, partially because it's digital and electronic, but there's no, in my mind, still no substitute for knowing someone in person, seeing them across the table in their own place of business, and that is something smaller funds can't always accomplish, especially given personnel resources, but someone reliable has to be doing, and someone that can be depended upon to do reliable work has to be in the background providing that information.
So a similar theme, Steve, but a different vantage point, and I absolutely agree with Sally's points, that you've got this invasion of fintech and artificial intelligence, machine learning, and it's the pure fundamental manager doesn't really exist anymore. It's at least quantamental, or these machine learning, AI tools are being used as part of the investment process. And now you see more and more asset managers have a data scientist sitting next to the CAIA or the CFA. So how have you seen a lot of this with your manager selections in terms of these more machine learning driven processes, and how does that affect your diligence on hiring these managers in terms of a repeatable investment process?
Maybe it hasn't affected me as much. I'm a bit of a Luddite and don't have a lot of the quantitative or systematic managers. I mean, years and years ago, I worked for Barra, which is kind of one of the preeminent quantitative firms. I know a lot of these people out there, and I think very highly of them, but I know they're all looking at the same things. So there is a big kind of systematic part. They're all looking at the same data. It's an arms race. But if you go look at somebody that's doing corporate credit work or restructuring, that's roll up your sleeves. That's reading documents. That's not AI. That's labor-intensive work. And that's what I've tended to turn over stones looking for some things that are smaller markets, smaller opportunity sets, where the managers have to get involved and do the work, and that they can't gather any, they can't get their edge or aren't getting their edge from just scraping data or looking at satellite shots. So I think more it's a compilation of just a lot of one-off hard workers.
Well, it's going to be interesting to see how this whole data invasion works, and it's still nascent, even though it's talked about quite a bit. But I think what it's certainly done in the liquid equity markets, it's made these markets much more efficient, and that's why it's so hard for active managers to beat an index. But Jim, turning to you, if I look at, I think Swenson in his annual report last year described the allocation to alternatives as allocating to inefficiently priced assets. He did not use the word alternative investments. And if I take that and extrapolate it, I think he's basically saying private equity, private debt, some of these hedge strategies are less well-traveled, less efficient, and thereby probably a better source for alpha. Is that still true? For all the money that's poured into these strategies, has it become more efficient and more difficult to find an alpha-generating manager?
I think it's definitely become more difficult to find an alpha-generating manager. And I think, what do we have, 12 billion-ish on stage? Maybe we could all do it, the four of us, but when you get into think about, I think of some of the pension funds, and I get into rooms with them, and we're all like, yeah, private equity is going to save our plans. Like, there's no way. There's no way that all that money can go into the same asset classes and expect the historical return. So kind of the point of 60-40 has worked over the past 10 years. If our expectation is private equity has worked over the last 10 years, and if we all just pump twice as much money in, it'll still work, that's a little ridiculous. And I think people need to think about that, because one of the other things is how many managers are really good in an asset class. If you think, just say long, short equity hedge funds, how many managers can really produce alpha? If you hire all of those managers that you think, whether that, I would say it's 2, you might say it's 20. But if it's 2 or 20, if you hire 20, can you really outperform the index? That's beta at that point. You've got 20 managers that own 10 to 15 stocks, you've got 100 stocks. The data says 25 stocks gets you enough diversification, so you've got 3, 4 times that. That's beta, and that's really expensive beta, so that's really difficult for me to believe that you're going to outperform. But Yale can do it because they get different pricing. We don't have the ability maybe to change pricing on that. So I think it's ridiculous to think that everybody, if we do the same thing, we're going to have these great returns. That's hope, which isn't a great strategy.
So I think that's a very good segue to private equity, which we wanted to spend a little bit of time on. So Angelique, one of the points I think was brought up throughout the course of this panel is that finding the right manager, not so much the right strategy. And private equity, hedge funds are really becoming industries, not asset classes. And if you look at private equity in particular and compare it to the public markets, the dispersion of results from the top to the bottom quartile in the public markets is very tight. Right. Private equity, it looks like this. But if you look at the averages, they're right on top of one another. So if you go into private equity and you're just accessing an asset class, are you going to get compensated for the illiquidity premium? Most likely not. And after fees, you've done no better than the public markets. So the adage is that unless you have a skill to find these top-performing managers, you shouldn't be in these asset classes to begin with. So how do you view accessing private equity, and how do you ensure, or at least hope that, and maybe hope is a strategy here, how do you hope that you've got the top quartile managers?
Well, our private equity and venture portfolio is pretty mature, so we started early on in venture. We've had great success, particularly in the venture area, probably a little less so in the buyout area, sort of chugging along with the public markets. But you have to be a little bit more granular. We have a consultant also who helps us on the private equity side of things, and they're a boutique firm out of Philadelphia, and they sort of have been able to provide us with some access to particularly top-performing venture managers and some good buyout funds. But you have to look a little bit more granular. Like if you look at the private versus public market performance in, let's say, consumer discretionary area in private equity, public markets have done better recently, to be quite honest. But if you look at some other areas like industrials and things of that nature, then private equity managers still have been able to put up quite good numbers. So we're looking more into sort of the more sectors. The landscape for private capital has changed dramatically. You used to talk about distressed and buyouts and then venture, and that was it. And now it's a whole plethora of things that are available to you. So it just takes a lot of work and sort of studying the market and trying to figure out where the gap is sort of in terms of opportunity and inefficiency.
Sally, I don't know if you saw any of the clips coming out of the Buffett Berkshire Hathaway annual shareholder meeting, but both good old Warren and Charlie were not very happy, and they left the hedge funds alone. That stupid bet is now a year behind us, and that's a topic for another panel for another day. We could do 45 minutes on that bet alone. But they picked on private equity for 2 reasons. One is the leveraging component, when you basically have this debt is being given away for free. So if you lever up a risk-on asset, any idiot could do that. And I don't know if he used the word idiot, but he called the presentation of performance dishonest or less than honest. So fair comments or not?
Well, yes, but I learned an adage long ago when I was still on the sell side at Wall Street, and that was, don't confuse brains with a bull market. And I think of that often. I've reminded a lot of people of that over the years. But the need, like Angelique just said, the need to investigate more deeply into into the funds and GPs you're considering, it comes at us in more and more ways. One is the leverage factor, certainly, but there are so many different levels of due diligence when looking at any private manager, whatever type of private it may be. The way returns are calculated, the way an IRR is calculated, the way public market equivalent is calculated at the portfolio level, at the individual company level, whether there's leverage in the portfolio, whether there's a line of credit that the GP draws on before turning to the LPs. All of those mean that performance presented by one GP is not necessarily comparable at the top line level to performance presented by the next GP, even if they appear to be doing almost exactly the same thing. So I think Omaha hit some good points, but also how nice for them if they can find the return and the alpha they need by ignoring private markets. I don't think we can just dismiss them for the reasons that they talked about.
I sense you jumping out of your seat here,
Well,
Steve.
they may have been a little unhappy in Omaha because they're trying to buy these companies too, and they're competing against private equity that has as much cash as Berkshire Hathaway has. I think there's a lot more dry powder in private equity. They take them public, or take them private. They lever them up a lot more than Berkshire Hathaway can do, and they never mark to market. So what wouldn't you like about that? I mean, you look, it's been you get, bull market for equities, and you've had really cheap finance, and it's been a great formula the last 10 years for private equity returns. Again, I don't know if that's going to go forward. Again, my colleague that focuses on buyout ventures, and venture has been doing it for almost 20 years, fantastic, has a great roster of managers. I look at it, I do some of the private debt side, I look, what's going to happen, if those companies go into an earnings recession? What's going to happen? Can they service that debt? What's going to go to the debt holders? If we stay in a low-rate environment, we're going to continue to see these yield hogs out there buying up debt with no covenants, no protection, no rights, no way to force a company into default. I look, I says, wow, I would not, I'm much more worried kind of on the debt side or credit side of private equity going forward.
Well, it's interesting that to pick on the cheap leverage, and I think Buffett and a lot of sort of shadow buyers who are sitting with big balance sheets that are not necessarily active in the market, family offices, sovereigns that have the ability to come into the market at any point. And one of the strengths they have is that they don't have a 7 or 10 year fund. So we're sitting on $2 trillion of liquidity right now. And the likelihood that Mrs. or Mr. GP is going to go back to the LP and say, Steve, here's your money back because there's a crappy time to invest. But Buffett can sit back, or some of these family offices, they could sit there and wait this out. And I think that's a tremendously powerful advantage. Because unless the distressed space might be a good place to be thinking about. But this $2 trillion of liquidity, I think, should be on the minds of everybody in this audience, and I assume on the minds of all of you.
They're getting 2% off that $2 trillion in liquidity, too. I mean, they might give back some of that capital. They're not giving back the fees. And so you've got a misalignment of incentives there. So that private equity in 10 years, and I've thought about this when we talk about this at our committee, it's got to be different, not just because of all the asset money that's going into it, but you think about some of those general partnerships. They've got succession planning issues. You see what happened at Kleiner Perkins. There's succession planning issues at a lot of those firms, and they're buying a lot of companies that have succession planning issues. So if you think out, you extrapolate that out for the general partners, what do they do?
Where are you seeing value, Jim, in the private equity space? The large buyout fund, I'm less sure about, but SMEs in India or China, there's a lot of risk attached to that, but the middle markets, are there particular sectors that you find interesting right now?
Yeah, we do all small funds. So we like to look at funds that are under $250 million because they don't use a lot of debt. They're not very leveraged. They're actually operating partners, so they're trying to extract value that way. Once you get over $1 billion, you're raising $1 billion, I think the alignment is different. And so it's not a red line, but once you go over $1 billion, we kind of lose interest. So we do a lot of fund ones, people that have lifted out of a $5 billion shop where they created a lot of alpha, but it was small deals and they're the older partners were destroying their carry. So they said, let's set up our own fund. So we do a lot of that. We've had a lot of success with that, but that's a different type of risk, because your committee members aren't going to be able to go to a cocktail party and say, we bought this, we're in this fund that did really well that everyone knows about. Nobody knows about this. We're typically the only endowment in these funds. So we're the only ones that are really reading the legal documents. So that creates a different set of issues. So you have to have a long-term mindset and be comfortable with a lot of that. Not everybody can do that. And if you're CalPERS, you can't do the same investments we do, because you're writing checks that are $500 million, and we do funds that are smaller than that.
Sally, did you want to add something?
So it's such a benefit to be able to think like what Jim describes, because many of us are strapped with traditional rules or traditional investment policy that says we can't go in unless we're at least on Fund 3, or at least the fund's X $100 million, or some other things that are supposed to indicate staying power and value of the investment thesis. And yet, that may be one thing getting in the way, with the ability to look at smaller, newer funds where typically there's more alpha, there's less efficiency, not so many people have noticed the space yet. There's, I think, a big benefit there, but it takes resources, right? Due diligence and oversight resources.
So Angelique, maybe combining those 2 points together then, we've established that this vintage year may not be the year to go all in the private markets. Is Penn State active in the secondary space, and do you find entry points to get other vintage years and vintage exposure?
No, we're really not, and I know we probably should be, because it's becoming a bigger and bigger area. And I was at the Cambridge Associates recent conference, and I think they showed a slide where only 14% of market participants don't get involved in secondaries at all. But we just haven't. I mean, we did sell some on the secondary market just because we had a conflict of interest with one of our board members. But other than that, we're not really active in the space as it stands now. Just not enough people and not enough resources to do everything.
Steve, we've got a couple minutes left. Last subject to cover, maybe alignment of interest between the GPs and LPs. I saw a headline in the Financial Times 2 weeks ago, a new concept for me called the super carry. And now the override in some of these larger funds where this demand is up to 30%. And I looked up the definition of a fiduciary, and I was trying to find the words "because we can," and I could not find them. To be charging a 30% carry in this market with $2 trillion of dry powder just does not seem to be the appropriate thing to be doing. So either on that point or generally, as an LP, how do you feel that the alignment of interest works between the Getty Trust and the managers, the GPs that you're investing in?
Kind of that concept of a super carry makes me a super crank, worse than usual. And we recently sold in the secondary, and we're selling in the secondary selectively because you can get near, par prices. People want to buy this stuff, and the partnership I sold, it's because the manager came out raising a bigger fund and raised their fees. And I said, there's something wrong with the alignment here. It smelled, I sold it. That was my response. And to me, it's becoming, these funds are raising a fund, they're extending every fund. So we're going to be partners for 10 plus years. So if I'm going in with any kind of concerns or I'm not feeling right, I'm just going to pass on that because there's something else. The alignment is so critical to me right now.
I can sense the crankiness. So we're down to 1 minute.
I've had my coffee.
We're down to 1 minute, so I think there'll be about 15 seconds of closing remarks, and Jim, we're going to go in reverse order.
The only thing I would say from a closing standpoint is think about, allocators have to think about how many funds they have, and can you really produce alpha with that many funds?
Yeah, I'm with Jim on this one. There's way too much diversification going on these days, and we are actually trying to sort of bring it in a little bit and reduce the number of managers, particularly on the equity side in the portfolio. Otherwise, you just get the market.
Excellent, thank you.
Or worse. The market less the fees.
Important point.
I'll add to the alignment topic. I never like to start an investment discussion with what the fees are. I'm after the net return after fees. And I'd rather pay someone a higher percentage of a higher return than start with the cheapest fee in the room and hope they can earn a little a return over that.
Steve, final word? Yeah, thank you.
We're turning over stones to find opportunities aren't crowded, and long-short equity is the toughest place to make money in right now.
Outstanding. Well, very good conversation. Please join me in thanking the panelists.